Hello there, welcome to Finance Teacher. This video is the second one in the series that discusses dual currency deposits. We discussed the basics in the first video. You can head over there if you want to learn the basics. In this video, we will discuss a DCD in two common and relevant scenarios, calculating the payoffs. Let's get going. We take the DCD involving GBP USD currency pair and examine it from the perspective of the bank and the investor. The investment is GBP 1 million, where GBP is the first currency in the quote and GBP is the investment currency and USD is the alternate currency. If the alternate currency USD weakens, the GBP USD quote will move up. Therefore, the strike price has to be set above the spot rate at the time of making the deposit. Here, the GBP USD spot is 1.25. The strike price of the conversion rate is 1.27. The interest is 8% per annum and the maturity is in 3 months or 90 days. 1 year is to be taken as 360 days. The first assumption in all these scenarios is that the bank invests the money it receives from the investor at 8% per annum in GBP itself. It does not convert GBP amount received from the investor into USD. Therefore, at best it can break even in the two most probable scenarios that we will discuss. Based on this assumption, we can calculate the returns for both the investor and the bank. Also note that the bank has only two choices in each scenario. Either it can pay in GBP or it can convert the GBP maturity amount to US dollars at the conversion rate. In effect, the bank can either pay GBP 1 million into 1 plus 8% into 90 by 360, which is equal to GBP 1.02 million, or it can pay USD 1.02 million into 1.27, which is USD 1.2954 million. Remember, GBP 1.02 million or USD 1.2954 million are the only two choices for the bank. The profit for the bank will essentially be the amount it gets from its investment, which is basically GBP 1.02 million, minus the amount it pays to the investor. Both these terms have to be in the same currency. We will convert the profit or loss to GBP. We'll first discuss a scenario where the spot rate at maturity is below the strike price. Let's say the spot rate is 1.23 on maturity, as we know that the conversion rate is 1.27. This is the simplest scenario. The bank invests the money in GBP, receives 2% interest for the 3 months. The spot rate is less than strike on maturity. That is, the investment currency depreciates as expected or wanted by the investor. The bank simply passes the interest to the investor. There is no conversion. This is what you would expect if the spot is less than strike on maturity and the bank does not surprise us. It takes the logical step. The investor gets the promised 2% return for the quarter, which is pretty good compared to the other options. The bank's return is equal to the bank's maturity amount minus the amount paid to the investor, which is GBP 1 million into 1.02 minus GBP 1 million into 1.02, which is basically 0. The investor's return is the amount received from the bank minus the initial investment, which is GBP 1 million into 1.02 minus GBP 1 million, which is GBP 20,000. Note that if the investment currency depreciates further, say to 1.20, the payoff for the bank and the investor will remain the same. This scenario gives the maximum gain for the investor if the bank remains rational in its choices. Therefore, this is the best the investor can practically expect from this DCD. In scenario 2, the spot rate at maturity is 1.30, which is above the strike price. This means that the investment currency GBP has strengthened above the conversion rate and the USD has weakened beyond the conversion rate. This is not what the investor wanted. As we will see, this move is in favor of the bank. investor wanted the GBP to weaken, or at least he wanted GBP USD to remain at or below the strike price. Since the alternate currency has weakened sufficiently, that is beyond the strike price, the bank will pay the maturity amount to the investor in the alternate currency USD. To recap, let's first calculate the maturity amount, the principal plus the interest in GBP. The maturity amount is equal to GBP 1 million into 1 plus 8% into 90 by 360, which is equal to GBP 1.02 million. Now, this GBP amount will be converted to the alternate currency USD at the strike price, which is the conversion rate. Therefore, the amount paid by the bank to the investor is equal to USD 1.02 million into 1.27, which is USD 1.2954 million. To get this much USD amount, that is USD 1.2954 million, at the spot rate of 1.3, the bank needs to spend GBP 1.2954 million divided by 1.3, which is GBP 996,462. Therefore, the bank makes GBP 23538 because it gets GBP 1.02 million from its investment, but only spends GBP 996,462 to meet its liabilities towards the investor. Mathematically, this can be seen as GBP 1 million into 1.02. This is the amount the bank gets from its investment, minus GBP 1 million into 1.02 into 1.27 divided by 1.3. This is the amount that the bank pays the investor. Simplifying, this comes to GBP 1 million into 1 plus 2% into the depreciation of the currency. Basically, you can look at it this way, that the bank benefited from the 2.3077 depreciation of the alternate currency. The USD depreciated with respect to the strike price both for the principal and the interest. That is, the bank gained by a factor of 1.02 times the depreciation on the principal. Note that the appreciation of the investment currency is calculated as 1.3 minus 1.27 divided by 1.3. Let's look at it from the investor's perspective. The bank pays the investor USD 1.2954 million. Now, if the investor converts this back to the GBP at the prevailing spot rate, he will get GBP 1.2954 million divided by 1.3, which is GBP 996,462. Therefore, instead of the 2% the investor was hoping to get, he lost GBP 3538. This can be written as GBP 1 million into 1 plus 2% into 1.27 divided by 3 minus GBP 1 million, which is minus GBP 3538. The first term on the left hand side of the equation is the amount the bank pays the investor, and GBP 1 million is the amount invested by the investor. The investor lost minus GBP 3538 divided by GBP 1 million, which is minus 0.3538%. Note that the alternate currency USD depreciated with respect to the strike price by 2.3077%. Note that the depreciation is calculated as follows: 1.27 minus 1.3 divided by 1.3. Now, had the investor borne the full brunt of the 2.3077 depreciation, he would have lost 2.3077% of the 1 million, or GBP 23077. This is because GBP 1 million into 1.27 divided by 1.3 minus GBP 1 million is GBP 23077. Basically, you multiply the GBP 1 million by the percentage depreciation to get this figure of GBP 23077. Therefore, the investor lost much less than he would have lost had he borne the full brunt of the depreciation. The difference, 2.308% minus 0.3538%, or 0.019538%, comes to a figure of GBP 19538 if we consider GBP 1 million as the investment amount. This difference is basically the value of the 2% interest on the GBP 1 million earned by the investor after multiplying it by 1.27 divided by 1.3. Therefore, the interest earned saved the investor, although the depreciation of the currency reduced the cushion. Also note that the more the appreciation of the investment currency, the higher the profit for the bank and the higher the loss for the investor. This fact makes it obvious for the bank to choose the alternate currency for repayment if the investment currency strengthens beyond the conversion rate. Since the bank invests the GBP 1 million received from the investor in GBP, not USD, the sum of the bank's gain and the investor's loss will be GBP 20,000, the 2% return on the investment. This condition will not necessarily hold if the bank initially converts the GBP 1 million received from the investor to USD and invests the USD amount at 8% per annum. To summarize, the bank made GBP 23538 and the investor made a loss of 3538 pounds. The sum total being GBP 20,000. This will always be the case if the bank invests the money in GBP, which, as we will see, it always will. Here, we end the part 2 of the DCD series. In the next part 3, we will discuss some wacky scenarios where the bank takes irrational decisions. Thanks for watching.